So it's 12 noon, and so welcome to the webinar. We're going to hold off starting for just a couple of minutes, just to let everybody get on board. So please stand by. So for those of you who've just joined us, we're going to wait for just a couple minutes to make sure that people who have registered have a chance to get in. So stand by for a minute or so. Okay, so I think we're going to get going now. So good afternoon, everyone, and thanks for joining the Homebuilders Association Vancouver today for the fourth in our special COVID-19 webinar series. Today's is the economic outlook, housing market impact and recovery. So my name is Mark Sakai. I'm Director of Government Relations with HAVAN, and I'll be moderating today's webinar. So first, I'll kind of walk you through the agenda today. We're going to go through some housekeeping and some guidelines for the webinar. I'll do a little overview of HAVAN's resources for that we've been providing during this pandemic. We'll do a very short 2-question audience survey. I'll introduce today's speakers, and we'll have Brendon's presentation, and we'll leave a little bit of time at the end for Q&A. So please use the Q&A function for that. And we should be finished by 1 p.m. So attendees, you are in view-only mode. So you don't have to worry about all that stuff, but please mute your microphones because you have no outgoing audio. So to ask questions, please use the Q&A function on the webinar screen. We'll hopefully get to your questions at the end, but depending on how many questions there are, we apologize if we can't get to all of them. There'll be opportunities to contact Brendon after the webinar. We'll have his contact information on the screen at the end. And we are recording this session, and we will be sharing it on HAVAN's eLearn page, which you can see. It's basically elearn.havan.ca. And you will have to register and log in order to access this recording and our other 3 webinars that we've produced in this series. But the recording is free. And also there'll be information there as to when the next session will be available to view. We usually get these sessions up within a day or so. Also, a quick note that during this pandemic time, we're offering 40% reduction on the cost of all eLearn courses that offer CPD points. So we also have created a special COVID-19 resources page on our website, havan.ca. So we update that pretty well several times a day, every time we get new information from various levels of government, as well as some of our whatever business resources are available. And a lot of the information that our members have shared with us on their best practices. So if there's things that you would like to see on that page and you don't see them, please send an email to me, mark@havan.ca. So just to get an idea of who is viewing this webinar, we're going to ask 2 very, very short questions, and then we'll provide you, the audience, with the results. So the first question is, what best describes your business? So a poll will come on screen. You can respond to the poll, and in about 10 seconds or so, we'll put up the results. Okay, I don't see the choices on my screen, Wendy.
Sorry, I'm just going to jump in here. It looks like the majority of people are Part 9 builders, followed by Part 3 professional consultants, and we have some municipality government in here, and a wide selection of people. So we have a great selection of people here today. Thank you for joining us.
Okay, and I guess we'll be getting to the second question. Which is, to what degree has COVID-19 impacted your business? And one of the reasons we ask this question is we get this question a lot from when we talk to government, when they ask us, how does the industry look on the ground? And so the responses to this type of polling is very informative for them to get a sense of what types of economic recovery stimulus needs to be put in place once we get out of this pandemic and look to restart a lot of these sectors of the economy that are shut down right now. And so here's the results. So there's still a significant number of people who are still operating, though with some impacts. Although it appears the numbers are slightly down from the survey that we did a couple of weeks ago. So I think that's informative for everyone. And so thank you for everyone for participating. So before we get to our speaker, I'd like to thank our presenting sponsor, Fortis BC, and also our patron sponsor, BC Housing, for their generous sponsorship of this special education series to ensure that we can deliver this content across the province to everyone in the industry at no charge. They both have their own COVID-19 response initiatives in place, so I encourage you to visit their websites for more information. So getting now to the presentation, I'd like to introduce our speaker today. His name is Brendon Ogmundson. He's Chief Economist of the BC Real Estate Association, which is a HAVAN member organization. Brendon's been with BCREA for 9 years, and he specializes in macroeconomic forecasting, housing market analysis, and econometric modeling, and is responsible for producing forecasts for the BC, Canadian, and US economies, as well as authoring quarterly forecasts for the BC housing market and Canadian mortgage rates. He's a member of the BC Economic Forecast Council and is also a contributor to the Philadelphia Federal Reserve's Survey of Professional Forecasters. So I'll hand it over to Brendon now, and let's get started.
Thanks, Mark, and thank you to HAVAN for the invite to come speak to you today. Let me just share my screen. I can't share my screen. So I think, Wendy, you have to stop sharing and then I can share. Is that right? Oh, here we go. All right, so everyone can see it so far. Good to go. Move this bar. Okay, so I'm going to be presenting our outlook for the housing market and the economy, and just kind of going through a number of the indicators, what we're seeing on the ground right now in the BC economy. Looking at the data that is available, obviously we're pretty early into what is likely going to be at least a deep recession. We don't know how long. But we're still kind of in the early days, and so a lot of the data is, of course, not available yet, but we will go through as best we can. So, of course, the number one thing driving everything in the economy and the housing market and really the global economy is, of course, the pandemic that we're currently in. I think everyone is probably following these curves as closely as I am. We know that Canada is doing a pretty good job in flattening the curve of cases. BC is doing kind of an exceptional job, kind of right along with some of the real benchmark success cases like South Korea, Hong Kong, and others. And so there's some really good news on this front, but obviously we're still in the early days of this, and a little too late to declare victory. We look at provincial comparisons, same story, just breaking Canada out. BC, again, doing a phenomenal job in getting the growth in its cases down kind of into that kind of 2% daily growth rate. hopefully we'll see that continue, and we'll keep pushing that growth rate as close to zero as possible, which will allow us to kind of get back to gradually starting to lift some of the restrictions that are currently really weighing on labor markets and weighing on the provincial, Canadian and global economy. So what do we know so far about how COVID is impacting the economy? Let me just move this around because it's blocking my slides. So what do we know so far? This is our monthly nowcast. So it essentially takes every piece of economic data that's released for the province and kind of tries to roll it into one number expressed as a growth rate in the provincial economy. You can see it tends to track actual growth in the economy pretty well. What we're seeing is, the economy was already slowing heading into this year. So we estimate about 2% growth in 2019, but really slow towards the end of the last year for a lot of reasons that are kind of forgotten now, particularly on the trade side and sort of challenges in the forestry sector and other challenges that have kind of been now pushed to the back burner. But the economy was really kind of growing at just over a 1% rate to start this year, so it was already in kind of a vulnerable spot. Our preliminary estimate for March, with as much data as we have in, really just labor market data and a few other pieces, we expect that March is going to be negative, so about 4.1% down. That kind of is close to the worst months of the financial crisis in 2008, 2009. The bad news being that March is really just the start, and we expect that April will be far worse, probably likely into double-digit declines. Though our forecast for the year, as we'll see in a few slides, isn't to stay at those levels for very long. So some of the most immediate data and how this is affecting the economy that we can see. One is this data from OpenTable, the service that lets you book restaurant reservations. You can see even as late as sort of February, places like Montreal and New Orleans, we're still seeing year-over-year growth. Even Vancouver actually seeing year-over-year growth in diners and restaurants. And then you can kind of see the progression as the pandemic is declared, and then as things got really serious in mid-March. You can see at this point we basically have completely empty restaurants all around North America. Another kind of real-time data is just measures the percentage of the population that's moving around a city. This is from City Mapper's Mobility Index. Again, you see 5 weeks ago things were pretty normal with a lot of movement, and then again that progression 4 weeks, 3 weeks until the most recent week when you just see people are pretty stationary, and this is sort of social distancing in data. People just aren't really moving around the city nearly as much. Interestingly, Seoul in South Korea sort of stands out here in that their mobility is actually starting to increase and getting back to where it was about 5 weeks ago, which I think really kind of shows their real success in getting a handle on the pandemic and how to get moving out of it. Obviously, this is having a pretty big effect on the labor market in Canada. So this was the claims number, or estimated claims number, since that data tends to lag in March. What the number is doesn't essentially matter that much. You can kind of see on the scale where it's at. About 1 million claims in March compared to the previous record, which was set in 2008, 2009. So as people who have to make charts for a living, this is going to be pretty difficult going forward because the scale has changed so much at the y-axis. I mean, that 2008, 2009 number was a big number, and you can see it's just a blip compared to the number of claims we've seen during this crisis. No surprise with that many unemployment claims. The unemployment rate in March also spiked higher for both Canada and BC. Canada to about 8%, BC to a little under that. Again, this is still early days in the data, and we expect that April is going to be a little bit worse. I would guess, well, not guess, we've modeled that the unemployment rate in Canada and BC is probably going to approach double digits, at least for a brief time. And we'll kind of get into what we see going forward and what policies can really mitigate a lot of that, a lot of the troubles in the labor market in a few slides. So we kind of look at what sectors of the economy in BC are most vulnerable, kind of immediately vulnerable to this particular crisis. Retail, obviously, without a lot of people out shopping and going into stores, that's 12% of employment in BC. Food services and hotels, that's another 10%. And then things like any kind of entertainment, recreation, cultural industries. Really anywhere where you have to leave your house and go somewhere into a crowd, that's about 25% of employment in BC, about 750,000 people employed. And those people are sort of the most vulnerable to layoffs because of this, because people simply aren't leaving their homes. And that's exactly what we saw in March. About 95,000 or so of the 130,000 jobs lost in the province were in those specific sectors. So there's sort of the good and the bad of this. If we can keep those people somewhat attached to those jobs through some of the policies the government's implementing, then they should be able to come back fairly quickly, because as long as, again, we can keep restaurants open, we can keep hotels operating, we can keep retail going, then we can get those jobs back fairly quickly, because the demand should spring back, but at least come back as people feel safer venturing out into the world. And then one thing that we have to talk about that doesn't really factor as much into this presentation, but as an economist, would be remiss without mentioning it, we saw negative oil prices yesterday, which I won't get into. It's just sort of one more complication in an already complicated world. But you can see Canadian oil on kind of spot prices has fallen to essentially worthless. I think it was like -1 cent. And then May futures for the sort of global benchmark, or the North American benchmark for oil prices, down to negative, as obviously if we don't have airplanes flying, we don't have cruise ships out on the ocean, we don't have a lot of demand on the roads, that means a huge amount of supply of oil is building up. And if there's not enough storage capacity, it just means they're not going to be extracted. It's going to shut down wells. You can't get rich, buying a school bus and driving it around, unfortunately, at negative prices. It just means they're not going to be producing. So what does all this mean for the Canadian economy? It seems like a lot of forecasters are sort of trying to outdo each other with how bad their second quarter forecast for Canada might be. I mean, I can still remember a few weeks ago only that the worst forecast you saw for the Canadian economy in the second quarter was down like 10%. I think I've seen down 40%. It's one of the most recent forecasts from I believe it was Scotia. Important to remember, those are annualized numbers. So when we talk about how bad a quarter is going to be, it's a quarterly annualized rate. So here our forecast is down about 4% in the first quarter, 20% in the second quarter. That 20% though is really a 5% contraction in overall output. So pretty serious. It's a steep contraction, but just keep in mind when you hear these big numbers, divide them by 4. That's the actual contraction in the economy. What we expect then is the next 2 quarters, or sorry, the first and second quarter, to be pretty rough overall, about from a peak to trough decline in Canadian output of on the order of 7 to 10%. We think you can see that dwarfs the about 4% decline from the financial crisis in that gray dotted line, and then a slow kind of recovery, but not even getting back to our prior trend by the end of 2022. So a big shock to growth. We'll get some growth coming out of it, but it's not going to be enough to really close that output gap in sort of the 2-year time horizon. What about the BC economy? So we expect a pretty steep decline in economic growth over the next few months, and then we should start to see things recover. Obviously, it's almost impossible, or is impossible, to time when things are going to get back to normal. It's not kind of up to anyone except the scientists and doctors that are in charge of these things, and so it's very difficult to time. If you assume that things are slowly, gradually being lifted, that the mitigating measures are being slowly, gradually lifted into the summer and the fall, then we should see the economy kind of come out of its depths, and we think we'll end up down about 4% on real GDP in 2020. And then because of all the stimulus measures aiding the economy, and just a general kind of bounce back. We'll see hopefully growth over 3% in 2021. And again, that's going to mean the unemployment rate probably spikes to maybe double digits. We hope with the right policies in place and an optimism about the recovery, we might get closer to that lower bound on unemployment and start to see a more brisk decline in the unemployment rate into next year. This slide is just kind of like a thought exercise relating the amount of time an economy is essentially shut down to overall loss in output. So if we kind of think that the economy is, say, around 100 at the start, and we shut it down, about half the economy is shut down for a month, and then we kind of gradually start lifting, and then 25% is shut down for the rest of the year or a few months. You see how that translates to a loss in output. So just in putting it in perspective, if we shut down a lot of the economy for a long time, that's going to mean a pretty gigantic hit to overall economic activity. So if it's sort of on the order of 5 months, we could be looking at kind of a 12.5% decline at those sort of levels of shutdown, which is why you kind of get into this back and forth about when should we be gradually reopening the economy? How long can we wait? Because there is a real trade-off on the economic growth side. And the sort of the longer this goes, the more permanent the damage might be, the less likely we get some of those jobs back, the less likely a lot of those businesses can stay operating for longer. So eventually we are going to have to see some measures to gradually get kind of people back into the workforce, as long as it's safe to do so. And of course, there's no reopening the economy unless people feel safe and confident going out into the economy. Okay, so on that topic, just as there's measures to flatten the curve of the pandemic, we also can implement measures to flatten the recession curve. And fortunately, it seems like we're doing just these things in Canada. The first thing, make sure workers can remain employed and that they can keep collecting paychecks. So you see this policy being enacted by the government in wage subsidies. We can quibble about how quickly they got to that point and how generous they were at the start, but we're getting to the right policies, and that money seems to be coming out pretty quickly. So keeping people employed and attached to their jobs, and giving them a paycheck so they can make their monthly obligations. Ensuring firms can survive through easier borrowing terms and financial assistance. We're seeing that as well. I think a lot of the efforts to get small business loans out to companies. A little slow on rent assistance and rent relief. I think that's going to be super important as well going forward. Obviously, for a small business, its biggest cost is its lease payment or its rent payment, and that'll put you out of business pretty quickly if you can't make that payment. So I think that's really important to keeping firms operating through this period. And then support for the financial system as well. And we see that in what the Bank of Canada is doing, what the CMHC is doing, what the federal government is doing in terms of providing liquidity to the financial system. So we can see just the scale of help. And this really is one of the reasons why we kind of see this not so much as sort of a stimulus to get the economy out of a recession. It's really more about disaster relief. You can see that in the scale of spending. The 2008-2009 financial crisis was obviously purely a recession. About 3% of GDP the government spent to kind of help the economy get out of that recession and into a recovery. This is way more like disaster relief, and we're seeing that in the scale of close to 10% of GDP being spent just to bridge people through this really difficult financial period. And this happened no fault of really anyone. It's not like a normal recession. This didn't happen because of poor business decisions or bad loans or misadventures in financial engineering. This is a lot more akin to a financial, sort of a natural disaster. And I think the response shows that. So that's what the federal government is doing. The Bank of Canada also throwing a lot of firepower at this problem, lowering rates to what they consider their effective lower bound of 0.25%. Also doing a lot of purchasing of government bonds, provincial bonds, even corporate bonds as announced, I think, last week, as well as mortgage-backed securities, all in an effort to get really every part of the economy, every type of borrower, trying to get their risk spreads as low as possible. So when a crisis like this happens, it tends to be a lot harder or more expensive for small businesses to borrow, or really anyone that's not kind of a top tier credit to borrow. And so the Bank of Canada is throwing a lot of firepower at just getting and keeping rates as low as possible during this time, so we don't see a big spike in risk premiums like we saw in the financial crisis. They were on top of this pretty early. It's pretty clear that they learned a lot from the financial crisis and how to get on top of these situations. And I think starting to show in the data that that liquidity is working. The United States obviously doing the same thing. So they have much better data on things like high yield corporate bonds. You can see that those rates were really starting to spike at the beginning of this. And a lot of the same facilities the Fed is employing are getting those rates lower. Canadian mortgage spreads are still kind of high, but that's largely due to the fact that bond yields have fallen to record levels. And then short-term rates are starting to come down as well. Or short-term spreads are starting to come down as well due to all of these programs that the Bank of Canada has implemented, and we expect those spreads to come down further and for borrowing conditions to ease. So we can see where rates are right now. Obviously, prime rate has fallen to 2.45%, given all of the cuts the Bank of Canada has made. So variable mortgage is now kind of around prime. I think most are offering kind of prime, kind of flat, or prime minus 20, 25 basis points. 5-year fixed rates had come up a little bit, as high as about 2.9. So despite this huge drop in 5-year bond yields, you can see down to a record low of 0.45% as of yesterday. Mortgage rates still hadn't really come down much. They're starting to ease a little bit now, down to about 2.8. One of the problems, though, is that the qualifying rate, so the rate you have to actually qualify at when you buy a home, is still stuck at just over 5%. So we're not getting, despite record low 5-year bond yields, we're not really getting any movement on qualifying rates. Even if we had not postponed the proposed changes to that qualifying rate, so it would be your contract rate plus 200 basis points instead of the 5-year posted rate, we would be at about 4.8, which would provide some relief. But even where it is now, if you just kind of, based on historical kind of correlations and modeling, that 5-year qualifying rate should be below 4.5%. But banks tend to like to keep that rate high because they calculate mortgage penalties off of it. And we just haven't seen it move very much, despite a huge decline in underlying interest rates. All right, so pretty clear that we're headed for a recession in Canada and in BC. How does the housing market tend to respond to recessions? So we went back and looked at the last 3 recessions over the prior 40 years in Canada. And we kind of find, Vancouver and BC home sales have, similar patterns when a recession begins. We get a sharp decline in home sales the first year of the recession, when the recession starts. And then you see a pretty vigorous recovery afterwards. Same thing on prices. We look at monthly prices. We get an initial decline over the first few months, and then prices tend to spring back pretty strong, and often actually end the year in the year of the recession. Actually, often end the year higher. Obviously, small sample. There's only been 3 recessions in the past 40 years, but regardless, we tend to see this pattern over and over, and a lot of it has to do with both pent-up demand and interest rates falling to really low levels. So the one time that prices didn't really rebound that strong was in 1982, coming off what was really a housing bubble in 1981, when prices rose, over 40% for the year, and even higher in Vancouver. And then mortgage rates went to 22%, and that caused things really to crash down for a couple of years. So obviously 22% mortgage rates are not in the cards this time around. On the housing start side, so for Vancouver, what do we normally see in past recessions? Often we see housing starts or new home construction fall to about 500 units at bottom. So pretty far down from where we are now. I think the most recent starts number for Vancouver is about 1,700 be a long way to go to get to a 500 kind of unit month. But we got there in each of the last recessions. Usually new home construction tends to lead or mark the start of a recovery as well. You can see in the past data. This time it's pretty interesting to actually see that survey data at the beginning. I'd be curious, maybe someone can tell me in the Q&A. I'd be curious how many of the people responding, I guess it was about 70% that said operating as before or a slight reduction. Be curious how many of those people were home builders or developers, because this time around, this is a really unusual recession, and we're kind of just tools down on the rest of the economy, but we still need all that supply in Vancouver, and there's no reason for us to really to decline to the levels we've seen in prior recessions, unless it's really drawn out and we get some of that longer term damage to the economy that I discussed before. So if anyone has some insight, I'd love to hear it. So this work here comes from a report we released yesterday, looking at how past recessions have impacted home sales and what kind of lessons we can learn from the past and from our own modeling, what we think is going to happen this time around for home sales. So you can see going back to 1981, 82, actually really all recessions, we get that kind of pattern of an initial drop in home sales, and then within a year we start to see a real recovery kind of above baseline. So that dotted line was our pre-COVID baseline, which works out to about 85,000 sales a year, more or less long-term average. And in the past recessions, we've actually seen home sales come way above the baseline in recovery. This time around, the orange line in the slide, we're expecting April and May obviously to be pretty bad as the industry and households adhere to social distancing, and we just don't get a lot of transaction activity happening. So we expect that kind of level of sales to more or less remain until the fall, when we start to see a bit of a pickup. Hopefully by then things are starting, or at least on the road back to some semblance of normal activity, and then we're kind of recovering back to that original baseline in 2021. What about on the listing side? So again, this is a really unusual situation. If we just model out, the depth of the recession that we're expecting, we would anticipate that listings, so the supply of resale homes, would start to really spike higher into the summer. And this is typically a time when we get more listings anyway. And with a recession, you tend to get an increase in listings. What we're seeing in kind of the real-time data, especially for Vancouver, is that while sales are down at about 30 to 40% for April, new listings are down like 60%. So it makes sense. If you're not out buying a home, you're not likely listing your home either. You're not looking to invite a lot of people into your home, even if it's virtually. So we're seeing listings activity really decline in the first part of April. So our kind of alternative, we kind of turn off the model dynamics for a few months, and instead we get kind of a dip in active listings, and then a slower and lower buildup of inventory headed into the summer. That has implications for prices, which I'll get to in a sec. On the new home supply front, not really an obvious pattern the way housing starts react in BC. They're kind of all over the map. You can see in the almost kind of a V-shaped recovery in 1992. The 2008-2009 recession is really fascinating because it started in February of 2008, but didn't get really bad until the last quarter of 2009. So, obviously we're not expecting that kind of acceleration from where we are. I think we haven't put together our forecast for starts quite yet, but I think we'll get something more like, somewhere between the 90, 92, 81, 82 kind of thing. We still need a lot of that supply, and it seems like home builders are still building. So, maybe we won't see as much of a dip. But how supply reacts to recessions is pretty important to how prices evolve. You can see again, though, pretty common patterns in past recessions in what happens to home prices. You get an initial dip, and then mean reversion is a pretty powerful thing, and things kind of come back to baseline in fairly short order, aided by pent-up demand and rising and falling interest rates. The big outlier there, of course, is 8182, which I already talked about, which was sort of a real housing crash and really high mortgage rates. This time around, we're expecting a similar kind of shape of the recovery. Next couple of months, we might see a bit of a dip. I think, interestingly, right now in Vancouver, prices are basically flat. So we haven't really seen much movement at all in April because, again, listings are falling faster than sales. So we could be on a path that looks a lot more like that alternative orange broken line, that COVID-19 alternative model scenario, where we get a much more muted reaction on prices and they recover a little faster due to falling supply. So what do we then see sort of the year following? Why are we kind of convinced that we'll see a stronger recovery? It's just generally how these things work out is that the year following the start of a recession, we just get a huge bounce in home sales. It's happened every time, from as high as almost a 50% year-over-year increase in 91, even in 2009, which if anyone remembers, I think as an economist in 2009, I think I walked around with kind of a pit in my stomach the whole time because it felt so awful while we were in it. And even then, prices in 2009 were up and home sales were starting to rise as well. So generally, we might sound very optimistic, especially from the point we're at now. But if we look back in history, I don't think there's a lot of reason we would expect things to be different this time around. This is a very unusual situation, so the timing is really difficult. But I think once we're out of this, there's no question that we'll see a pretty strong recovery. So if you're interested, want to read more about anything I said here, we did release this report yesterday, kind of detailing all of these scenarios and what we expect. Also on our website, you can find all kinds of other stuff. We have a dashboard that we update every week that you can track different economic indicators, and also our monthly nowcast, which will be pretty interesting going forward. And that is it. Time for questions. So Mark, are you going to moderate the questions? Mark, anyone?
Sorry, I'm not sure what's happening with Mark's audio there. So first question. Give me 1 sec. We had a few questions. Is Canadian housing, especially in cities like Vancouver and Toronto, too big to fail? Policymakers have kept housing on life support thus far, buying mortgages, deferring mortgage payments, etc. during the crisis at future taxpayers' expense. What happens when the next crisis strikes? Will those who are irresponsible and over-leverage themselves be bailed out? The moral hazard is insane. So I'm not sure if that's something you could answer there, or should we?
Is that a question?
I don't know. It's a statement.
Yeah, obviously there's a large level of debt, and that's one of the vulnerabilities this time around. Again, though, if this is more akin to disaster relief, and so a lot of the policies designed to keep people able to pay their obligations, I think, is really important.
Next question is, or maybe question or comment, to your question about you're mentioning business as normal, and some people are suspecting that maybe the major hit will come in the next 2-3 months when our existing workload is behind us, especially with the building community.
So is a lot of the work being done right now kind of like finishing what's already been started, but maybe new construction or projects that were slated to start over the summer maybe are being pushed. It's interesting what we'll see in the data going ahead.
What macro levers do you suggest will move the recovery economy and especially the real estate industry into a more sustainable direction, less automobile-based transportation, less waste in construction, less loss of ALR, land, et cetera?
Yeah, I mean, I don't know if they're macro levers so much as one of the one of the biggest issues we always point out is that, especially the city of Vancouver, is just really bad at matching supply and demand in real time. So we get these situations, demand can change really quickly, and supply can take up to 5 years. If you add in the permitting time to build, it can take forever to get new supply to market. And I think the biggest struggle that Vancouver has, and why there's so much strain on prices and why we get these cycles, is that we just are really bad at matching supply and demand. So the more sort of municipal levers or I don't know, other legislative means, I don't know, to try and get supply to market faster, I think would be more important than just about anything.
Oh, I've got my microphone back, I believe. So Brendon, there's some really, really good questions here. Do you think that there's going to be a difference in terms of the impact on construction between market housing and non-market housing? Do you think there's going to be a difference between multifamilies and single family? Or is that your level of analysis not that granular and you're just basically looking at overall?
Yeah, there's sort of enough uncertainty with forecasting. The more granular you get, obviously, the wider your confidence intervals are going to get. So we haven't modeled anything like that. Most of what we're talking about is market housing, design, targeted at ownership. On the rental side, obviously, there's still going to be a need for that rental supply, and lower income too. If there is more longer term damage to the economy, and we have an unemployment rate that's high a little bit longer, we're going to need a lot of low income kind of support as well. So, I don't see either of those sectors necessarily slowing that much.
Okay, and I'm wondering about one of the things that we've been talking to some of our members about is the concern about municipalities accepting and processing new applications. They're pretty well working as quickly as they can to work on applications and permits that are in stream. But there's a concern about, okay, what does the pipeline look like if some municipalities aren't or are very slow to process new applications, and especially with things like public process being sort of public input being sort of up in the air right now, how our rezoning is going to happen. Is there a concern that the pipeline could run dry after all the stuff that's kind of being constructed right now, and things that will be approved during this the in-stream stuff that will be approved during this this pandemic is under construction? There's going to be this gap in the pipeline.
Yeah, I wonder. I mean, there's obviously a huge number of units under construction right now. And so, I mean, is your concern sort of out 5 years from now, or is there, I mean, there's so much under construction. Starts are actually pretty strong, around, I think in BC, around 35,000 on average a year right now, that pace. Are you worried about once sort of all those projects start to complete and there's just not, and then the pipeline dries up? Is that the issue?
Yeah, I guess my concern is that there's, if the pipeline kind of depends on a flow, a constant amount of projects being processed and being approved, and new projects coming in the front end of the pipeline. If there's a gap where the new projects aren't being allowed to go into the pipeline, or their process actually takes longer because we've all of a sudden got this challenge that a lot of municipalities have on doing the public hearings. Yeah. Is that gap in the pipeline going to cause a problem down the line?
Yeah, I think you would know more than me. I'm always concerned. It seems like part of the problem in just getting stuff, supply to market, right? Like there's all of these issues where we need to really streamline the ability to get that supply there. And so, yeah, I mean, I'm just always sort of concerned about, why does it take so long to build an apartment building in Vancouver, and can we get that time down? And so, yeah, I don't think I have an answer necessarily to your question, but it's certainly a concern.
Okay. Now, how about some of the things that organizations like ourselves and BCRA have been talking about to the federal government on mortgage policy? Things like reducing the amortization periods, either modifying or eliminating the mortgage stress test to sort of kickstart especially for first-time home buyers, in the to sort of get the building economy moving again. Do you see that type of thing happening?
Yeah, I think one of the problems is that there's this sort of asymmetry in macro-prudential policy. So any policy that's designed to slow or speed up the housing market, but there's this asymmetry that we only ever tighten macro-prudential policy these days. We were slated to have a change in the stress test rate for insured borrowers, so for some home buyers. Excuse me. But that was postponed. I think now is a perfect time to go through with that change and stimulate some activity in the housing market. I don't know why they would postpone it. I think it was a concern about encouraging people to take on more housing debt, especially as interest rates are falling. But they were going to do it anyway. I really don't see why they wouldn't do it now, because it can only help with the recovery as we get more activity in the housing market. So I would hope that we would get that change from the posted 5-year rate to your contract rate +2, especially as interest rates keep coming down.
Great. How about, I got a couple questions about your graph on oil prices. Is this crisis sort of marking the beginning of the end of oil as the dominant, commodity? Obviously there's going to be some recovery of oil prices once the demand goes up again. And what type of impact would this have long-term on Alberta?
I'm pretty sure I instructed you before not to ask me any of the hard questions. Yeah, I wish I had a good answer to that. It does seem to be, from what I've read, it seems to be mostly a short-term May issue. So the fall off in demand and the excess inventories. If you look at futures markets, things are supposed to prices bounce back in June. But when an oil price goes negative, it's pretty strange. And some of it might be just weird market stuff. Some of it's just excess supply that, hopefully, obviously there's going to be a lot of policy thrown at this as well, and some pressure on suppliers, oil suppliers, to really scale back on production. So I think it'll work itself out, whether we go back to some other level of sort of normalized level of oil prices. I don't know, is the cruise ship industry coming back anytime soon? But, obviously that's not the dominant buyer of oil, but certainly one. When is airplane travel going to really kind of get back to fully utilized? So it's a longer term issue with oil, and unfortunately not my area of expertise.
Fair enough. Maybe this one will be a little more up your alley. There's a couple questions about the private mortgage and private lending market. Do you see them becoming more strict with their policies and maybe sort of retracting their aggressiveness into the market, or vice versa?
Yeah, so I think mortgage investment corporations are, I think, about 1% of mortgages. So, and they're obviously cater to a riskier segment of the market, but they're also compensated for that risk. So, unlike in say the financial crisis when the U.S. had a lot of these sort of schemes, but with very low teaser rates that would reset, these are already you had to pay a pretty significant spread to get a mortgage through those structures. So I think I would be concerned that I'd have to know a lot more about what makes up the portfolio of a lot of those mortgage investment corporations, whether or not those borrowers are really that risky, or that's just a problem with income verification. But I would be a little worried about that segment and about the assets that back the cash flows for those structures to maybe be more impaired this time around, just because I'd have to assume that the risk structure is a little more likely to be, or the assets are a little more likely to be impaired. But I'd have to know a lot more about it. It's a smaller portion of the market, so we'd have to kind of see. It'd be interesting. It's gonna be a really interesting case to see what the default rates look like on those mortgages.
Okay. So Brendon, when you do your sort of modeling and tracking of activity, do you ever look at the renovation market? And if so, do you have any sort of specific thoughts on what the impact of this pandemic would be on the renovation market and what the post-pandemic recovery prospects are?
Yeah, I mean it's not something we look at that closely. Obviously, it's a huge part of residential investment. So I would guess in the short run, you wouldn't see a lot of people having workers into their house over the next few months. So my initial guess, just on an assumption, is that you wouldn't see a lot of work being done in the next few months. So I think on those kind of residential investment side overall, I think we would probably see a slowdown this year. Again, it seems like one of those things that once people are comfortable having people in their homes, and especially if you can get a pretty low rate on a line of credit or something, or some of the finance renovations, I don't see why that market wouldn't really spring back to life. I mean, low borrowing costs and people have been stuck in their houses for a long time, maybe start to see a lot of the deficiencies they want to change. So, who knows, maybe by the end of this, there'll be a real bounce in renovations.
Yeah, and I think that's kind of like what we're hearing from a lot of our renovators, is that a lot of them are very reticent about letting a lot of people into their house. So, yeah. There is that, if they were thinking about a renovation or just starting one, then there's no reason why they wouldn't continue on, unless, of course, their household finances have taken a gigantic hit.
Yeah, I mean, if you're stuck in your basement in the next couple of months, you're going to start to really hate the look of it, maybe, and you want to get some work done.
Yeah. So, a question, I guess it's more of a personal finance question, is that if someone had a mortgage renewal coming up in the next, say, 6 months or so, is there any advice that you would provide on what their strategy should be in terms of a renewal? Should they be variable? Should they go short-term fixed, or should they go long-term fixed?
Yeah, I mean, it's kind of up to your own risk appetite and how much you want to be monitoring, right? So I think that Bank of Canada, usually when they cut to these levels, or when they cut in general, take kind of 12 to 18, 24 months to start tightening again. So if you're on a variable, you're going to be at those levels. You could probably safely pencil in for a couple of years. Then when rates start to rise, I mean, but where we're at on a variable, say at 2.5%, versus a fixed at 2.8, and probably coming down hopefully to under that, that's one rate increase. So 5-year fixed maybe is the best way to go for peace of mind. You can lock in at a pretty low rate, and at a rate that a variable would eclipse once things start to tighten. But again, up to everyone's individual risk preference.
And I guess we have time for one more question. I guess this one has to do with local governments. Do you see them being more motivated because because of the fact that a lot of them are seeing their revenues crater right now? Do you see a lot of them being really motivated to drive the construction approvals, so that that type of fees and license permits revenue doesn't show a drop, and that they can see more improvements happening in the housing market in their respective municipalities?
Yeah, I guess, I mean, a lot of kind of governments at all levels are going to be really squeezed budget-wise by this, and there's not a lot of ways, I guess, for municipalities to raise those revenues. So maybe one of the ways is to have more fees from builders and approving things quicker. If that's a way we can get things approved faster, then so be it. That would be great.
Yeah, I think certainly part of our primary messaging to local governments is a way to make sure that we can keep this industry moving full speed, and essentially provide that sort of stimulus to kickstart to the economy that every level of government wants to see. Yep. So I apologize for not being able to get to everyone's questions, but there were quite a few of them, and I tried to summarize as many of your thoughts as possible. I really want to thank everyone for joining us on this webinar, and a special thanks, of course, to Brendon for sharing your insights. Thanks to BCRA for letting us borrow Brendon for a little while. and to talk to us about the impacts on the economy and on the market, and how things might look post pandemic. So next week we will not be hosting a webinar, as we have another online event, which is our AGM. So those of you who are HAVAN members who have not registered for the AGM, please do so. But we will look to Zoom some more webinars in this series starting the first week of May. If you have any thoughts on what you'd like to see in terms of topics on future webinars, please let us know. You can email me at mark@havan.ca or Wendy McNeil at wendy@havan.ca. I encourage all of you to check our industry education page to find out when we have courses coming up. And of course, these webinars are available on our eLearn page. That's all we have for today. Thanks again for joining us. And again, thanks to Brendon for providing your insight. Thanks to Wendy for setting this all up. Thanks to our sponsors. So goodbye for now.
Thanks for the invite. Thanks, everyone.